Well, good morning, everybody. This is Louis Lowe, and thanks for joining our, I think this is our fourth webinar on, as we're all sheltering in place from home and trying to find out smart ways to navigate our way through our current predicaments. We've assembled just a rock star group of folks that I'm really proud of our attendees today. Lynn Haddad-Somers from Cabrillo, who is a valuation firm I've been working with for over 10 years. My good friend Vitaly Galamb from GS Capital, and my good friend Greg Kovacic who's the CFO at Doc AI, to give kind of the internal CFO perspective. And today we're going to try and cover a wide range of topics about how you can take advantage of the current environment to look at your valuation and drive as many positive outcomes as you can. Before we get started, though, I wanted to give Lynn, Vitaly, and Greg just a few moments to quickly introduce themselves. Lynn, do you want to start?
Sure. Thanks so much. Lynn Summer with Cabrillo Advisors. We do business valuations. We're a national firm. We've been around for more than 10 years, as Louis mentioned. We'll do about 500 valuations a year. About 300 of those will be for early stage companies for things like 409A. And so we see a lot in the startup space, but some more developed companies as well. Thanks.
Thanks, Lynn. Vitaly, you want to go next? My partner in crime?
Yeah, so Vitaly Golem here, managing partner of GS Capital. We are an M&A boutique, so we raise capital for companies. We execute on M&A projects. We also advise corporates, corporate venture side, investment, and M&A. And I've been on all sides of the table, been corporate venture at Hewlett-Packard previously, an entrepreneur for many years before that. So I can give you multiple angles here.
Hey, Vitaly, thanks for joining. Greg, introduce yourself.
Hi, everybody. My name is Greg Kovacic. I'm currently the CFO of Doc.ai, a health tech startup, and XY.ai, also a health tech startup. I bring about 20 plus years of experience in the corporate finance strategy world, both in the corporate side, consulting side, and startup side.
Greg, thanks so much. And we're not going to talk about anybody's company or specific circumstances that might be confidential as we go through our discussion. But as Vitaly, Lynn, and Greg and I were huddling up before beginning the broadcast, we definitely want to make this an interactive discussion. There's a Q&A button through the Zoom function, and as we see those questions, we'll try and address them. If not, we'll grab them at the end. So feel free to use that function. I guess I wanted to start off by just kind of setting the stage on where we are. Obviously, the stock market has been incredibly volatile for the past few months, and values of privately held companies have likely changed as well, as those of us who are doing transactions are finding out sometimes the hard way, sometimes a good way. Lynn, I guess my first question to you is how does the rapidly changing landscape for public company valuations in the public markets translate its way into the private markets?
Sure, yeah. So the stock market can be an indicator, and obviously we look to the stock market for market multiples, which can be indicative of value for privately held companies. But in this landscape, we'll talk a bit more about this, but it can be really hard to apply those multiples, and they may or may not be as relevant. What you really want to make sure you look to will be the forecast of the individual business. What's happening with that business is really why private company valuations are changing the most. But then there's also the factor that we use public companies as a proxy. And so that has a big impact as well and can create very volatile valuation issues in privately held companies as well.
So Lynn, just digging in a little bit more on the whole public comp issue, we had this huge cratering of the stock market in March, and then it kind of lifted back up in April, and now we're almost flat for the year as we kick off May. And I just wondered, how does that volatility translate on a day-to-day basis?
Yeah, so it's very it depends partially on the purpose of your valuation, but generally speaking, the value is as of the day of the valuation, depending on the purpose of it. But if it's as of today, then the value today matters. And so if you've somewhat recovered and you're one of the industries that has somewhat recovered, then that, you may have a perfectly recovered valuation. But the question is also, when you take a market multiple and apply it, what are you applying it to? And if you're applying it to a measure of revenue or earnings that is also shifting because of the environment, then that can have a really big impact on value as well. So it's not just the multiple, but it's also the measure.
I guess that takes us to the deeper question, Lynn, is just how do you value a privately held company? Obviously, public company comparables are only, one of those inputs, and a company's business model is another. But could you kind of take us through the process, and you get hired to do a valuation, and what are the kind of elements of value that you look at?
Sure. So the first question we always ask is, what's the purpose of the valuation? So, Vitaly was mentioning fundraising, M&A. So if your purpose is I'm out to raise capital or I'm trying to sell my business, obviously you want to understand how to maximize value. If your purpose is for 409A or for tax reporting or even for accounting, you may have kind of a different bias or view, in how you're looking at things and where you want things to come out. And there can be very good business reasons for those to differ as well. You may have a very optimistic and more aggressive forecast if you were to raise capital, because you may be able to grow more quickly by hiring a lot more salespeople, for example. So there's three basic approaches, and they kind of go with the stage of the company. And so one is an asset approach, where you're going to say, what are the assets that the company has, and what assets have they started to build that may have some intangible value? And that may be all that we can look at for a very early stage business. Another would be market approaches, as we spoke about. So comparable companies, comparable transactions, and even transactions in the company's own securities. And so if you go out and raise capital, you're creating, if it's with a third party, an indication of value. And so we would look to that to value the business, to value the different securities in the business, especially for 409A purposes. And then the last is looking at the future cash flows of the business. And this may be one where intelligent minds can disagree, but a lot of people will tell you a discounted cash flow is kind of garbage in, garbage out. But I feel strongly that, especially in an environment like this, having a well thought out forecast where you understand what the impacts of certain things will be on your business and how much risk is in your forecast, and can really explain a forecast well, can help you eliminate uncertainty, which is very tough on value, and in particular maximize value.
Thanks, Lynn. And Greg, tell me, when is it that you think about engaging somebody like Lynn and Cabrillo Advisors to come in and do a valuation? You've been the CFO of a number of companies. When is it that you make the call?
Well, legally, you have to do it when there's a material event, like you've raised outside capital, you've landed a big customer. But I think the key distinction is you want to provide protection to your investors and your employees when you're granting options, or when they want to do anything in terms of estate planning and things like that. And the point that Lynn raised earlier was a good one about the future forecast, garbage in, garbage out. But the real value of the future forecast is understanding the drivers of the value, not the number itself. And by understanding the drivers of that value, you can actually show prospective investors and customers and your leadership team how you're going to drive value and what you need to have in place to actually deliver that value. And if anything changes within that context, then obviously that valuation is going to change, because your operations are going to change. But the key really is raising capital or issuing options, because legally you have to have it in place.
That's a great point. Oh, sorry, Louis. I was just going to add on to that if you can explain your drivers, then a potential buyer or investor can also make their own adjustments to what they think the forecast may look like. And they may or may not agree with your inputs, or may want to sensitize them and look at some different scenarios, which they can only do if they really understand what underlies your forecast.
Thanks, Lynn. And Vitaly, you're running a FINRA registered broker dealer called GS Capital, and you're, I imagine, helping a lot of companies go to market for fundraising, as well as go to market to sell themselves. And so obviously valuation is a big component of what you do. And as an M&A banker, how do you come at the private company valuation that's different than what Lynn and Greg have described?
Yeah, so I mean, in our process, when we work with companies for a capital raise or an M&A, the process itself takes a number of months to get through, start to finish. And at the onset, important exercise we go through is look at the market, look at comps, and try to set the expectations for the team, make sure they're realistic. The venture capital methodology for valuing companies is quite different than DCF. A lot of times you're looking at companies that are pre-revenue. You just can't do DCF on a company that doesn't have any revenue. So the methodology, for those not familiar, is much closer to how you would value real estate, right? You look at, say, okay, this house has about, this size and this size of a lot, and it's in this neighborhood. How much do houses like this go for? And that's pretty much kind of more the art and science of venture capital valuations. So we have to look at it. We certainly try to kind of split the kitty a little bit, and we definitely look at public comps, private comps, and we kind of cook in the DCF and try to find kind of an average between all of these to set the expectations. But certainly in our perspective, when we're acting on kind of on the sales side on behalf of companies, we try to find, the right comps and try to get the best possible, believable, sellable valuation out there. That's an important exercise. Yeah.
So I'm going to kind of depart from the script and just come at it head on and address the elephant in the room. Is there a COVID-19 discount to private company valuations in the market today? I think in the public comparable markets, perhaps not, at least not on a market basis. Maybe as you go in by sector, you might find one. But generally, do you feel like there's an overall COVID discount? I'll start with you, Lynn. Yes or no, first off, and then 10 seconds as to why and whether it sticks.
Sure, I would say yes, but only that it's not an overall discount that you can apply, like 30% COVID discount because of uncertainty. It's much more company specific and digging into what's different about the projections and then comparing the old to the new.
Right. What would you say, Vitaly? COVID-19 discount?
Yes, certainly, because there's uncertainty and a couple of things. So on the public markets, first of all, the recovery has been very uneven, right? You have companies that have been affected tremendously. There's a surprising amount of optimism out there. I find that even for companies like cruise lines are shutting down, and they jump 20% because they reduce costs. Like, you don't build a business on reducing costs; you build it on revenue.
Right.
So that aside, but for private companies, what we've seen is it's not necessarily just the valuations changing. It's that we're seeing a huge retraction in the speed of deals getting done. Because all of a sudden VCs have been pushed for the last, at least half decade to speed up deal making and make quicker decisions. Now it's kind of payback time where the process has slowed way down. And my advice to companies has been, if you don't absolutely have to raise money right now, wait a little bit. Because you might just get a no right now. But the deals that are getting made, the multiples are being discounted. VCs, certainly when there's leverage, they will kind of look at the negative case scenario, and then all the comps and everything kind of gets deflated. The good news on that is also there's the macroeconomic effects of people getting laid off and commercial real estate getting cheaper, is your costs are going to come down as well. So it's there's a little bit of this and a little bit of that. It's
Greg, you're not going to take that. There's no COVID-19 discount, right?
Well, just to be, I guess, a little bit difficult so we can have a good debate is, there's a different application to both the debt and the equity markets, right? If you look at the debt side, the value of the debt's gone down, and that's driving a massive increase in the cost of debt capital. I mean, even established companies like Airbnb are paying double digits on debt just to ride out the storm. I think what you're really seeing is the future by definition is unknown, and everyone's trying to hedge their risk. And to Vitaly's point, anybody in a position of leverage on the buy side is going to use that leverage to pay less. But at the end of the day, a company is worth what someone's willing to pay for it, and if someone's willing to sell it for that price. So at the end of the day, you have to find the happy medium. And I think the discount really just comes into the fact that you now have uncertainty into the future of the business, certainly in areas that are driven by consumer spending, discretionary spending, rely heavily on foot traffic. That's why you see a company like Netflix, it's massive subscriber increase. I mean, Disney, hit their 5-year target for Disney Plus subscribers in 6 months. So I think the discount actually drives an increase in activity to different areas. So it's not a blanket discount across the entire economy.
Well said. Well, I'm going to sort of synthesize what I heard, and from my own perspective as a lawyer serving companies all across the technology and healthcare spectrum from here in Silicon Valley, I think it's incredibly industry and sector specific. I am seeing an attempt by sophisticated investors, whether they be in private equity or in venture, to talk about a COVID discount, and certainly for those deals that were in process previous to COVID having started, I think they're trying to reintroduce, those investors are trying to reintroduce discussions at a different valuation. They're trying to put it on the table and drive a lower number. And in some cases they're successful, in some cases they're not. And then I think there are a number of industries where we've seen no discount at all, and in fact an uplift in value. Companies that can help enable remote collaboration, companies like Stripe that can enable the easy transfer of funds and help companies commercialize, and it's really across the spectrum. I think we've really talked about market multiples and comps. So I think I'm going to skip this slide and talk about, do we think that there's been a valuation? Do we think that a December 31, 2019 valuation is still valid today? And I'll start with you, Lynn.
Sure, and we're getting this question a lot, and generally speaking, and we've alluded to, it depends on the company, it depends on the industry, but what we're finding is that December 31st, 2019 is very out of date at this point. And, auditors are looking at going concern for all the businesses that they, audited as of 12/31/19. And I would actually say almost through, parts of March, that if we've done a valuation for you, that may now be out of date. And that matters depending upon what you're using it for. And we can talk some more about that. But, absolutely, tons of them are out of date, and it could be on the upswing, and those have kind of been the surprises for us, but certainly a lot of them are lower, and most of them are not the same.
So I want to just kind of set the stage from a legal perspective, why we're in touch constantly with folks like Lynn and her partners at Cabrillo Advisors for third-party valuations once a year, is that in order to grant equity with a safe harbor under the Internal Revenue Code Section 409A, without the risk of having your valuation for purposes of determining the exercise price as doubted as having been below market at the time of grant. If you have a third-party valuation that was done within 1 year, you have a safe harbor for using that valuation, unless there has been some material event that makes that valuation outdated. And typically that event is a financing or an exit or a major increase in value, maybe because you found gold in the backyard, you signed up Disney as your customer, something like that. And so people like Greg and I are constantly in contact when there's a quarterly grant of options, is, do we have a valuation that's current, and are we still comfortable that the current valuation within 1 year is still valid? And then as long as then the board of directors, when it approves the grants and the exercise price, can have a safe harbor, rely on 409A, and not have a cheap stock issue come up later or another tax issue come up later. And so that's why it comes up in the private company situation, what I'll call on an operational basis. And then on a strategic basis, it comes up as venture firms that are investors are looking to market their valuations. And I think all of our venture firm friends have recently gone through the excruciating exercise of marking to market their portfolio as of March 31 through the month of April, and even now. I think some firms are done with that exercise, some firms not. And obviously, a venture firm doesn't have an interest in seeing the value of their portfolio marked down, although I think many have done that to some extent. For example, those investors in WeWork have announced publicly that they've marked down the value of that investment as that company has seen some trouble, and I think that's just one example. Then, as you bring your company to market to either come to sale, some sort of an exit liquidity event, or you look to fundraise, or there's a transfer between founders, or some sort of a change in the ownership structure, a recapitalization, some sort, or it could be a trust and estates event where a founder is looking to transfer shares in that founder's private company to a foundation, a trust. There's something called a GRAT, which is something that's widely used in the state of California. And in those cases, for estate and tax planning purposes, you want to have a current valuation. And so those are the reasons why, we're talking about this whole subject. And Lynn, would you say that you've seen a real uptick in activity as companies, spend more time with you and looking at all of these, potential uses for a new valuation?
Yes, and as I mentioned, some of it's even redoing work that was done so recently, just to make sure that it's up to date and that it can be used for incentivizing, which we can talk about.
Yeah, well, I'm jumping ahead, and really, one of the drivers of this phone call today and this webinar was conversations that Lynn and I were having about, what can we do to take advantage of this environment to, drive good outcomes. Let's face it, we're all dealing with some tough situations, and what's the silver lining in the clouds here, Lynn, for companies that might have suffered a decrease in value? And we know that Greg, this is totally irrelevant for Greg because his company is just going up and up to the right. And I'm not being facetious. Lynn, tell me, what are the strategies for decreases in value?
Yeah, I mean, it's generally considered to be a negative kind of across the board, as you were saying, for investors, et cetera. But there's a couple things that can be a little bit of a silver lining if your value has decreased, or if your outlook isn't as good and you think that may lead to a decrease. A couple things to think about. We're all struggling right now with employee retention, morale. How's everybody feeling? Did you have to lay anyone off or furlough anyone? And this is actually a time when you can use a lower valuation to help incentivize employees by issuing stock options at a lower price. So that is kind of a one good outcome. As Louis mentioned, the strike price is going to be based on the common stock value, and you have to update it when there's a material event. And this certainly is being viewed as a material event, kind of across the board for just about every company. So, that's one where you can kind of turn this around and, issue shares, issue options, and have beneficial outcomes for employees where they can get a nice low strike price for some future acquisition of stock.
Vitaly, anything to add from your perspective as an M&A banker in the space, and any other kind of silver linings and ways that you can take advantage of the decrease in value?
Yeah, I mean, I think Lynn hit it brilliantly. I'd love to disagree, but I can't. I think that's that's actually a really good point. Is that you do need your stock, and you do need to maintain your team. Like we've talked about, in previous episodes of this recurring webcast. Is that if you are doing headcount reductions, and Uber just announced today, Airbnb announced yesterday, big companies doing big reductions, you do need to motivate the team that remains, and one way is, of course, kind of doubling down and giving them some upside to stick around and to have faith in the company and kind of get through the storm. So that's definitely an area. As far as M&A and raising capital, again, I don't think a 409 valuation really comes up much in those discussions, right? Certainly, you're not going to have completely two different ways to value the company overall, but 409 valuations for common shares, right? And preferred shares are valued much higher because they have certain privileges over the common shares. I don't know if we need to kind of rewind and hit those basics maybe, just to kind of explain a little bit deeper for those folks that might not know absolutely all the nuance between the commons and preferreds.
I think that's valuable to hit that. And so, as a company is formed, all it has is common stock, and it has usually in some sort of an equity pool to grant future shares of common stock or options for that are exercisable into common stock as and when the current market value is reevaluated in the future. And then as it raises capital, typically it'll start with convertible notes or safes that will then convert into preferred stock. Preferred stock usually is last money in, first money out. It has a liquidation preference or a liq pref, and the liq pref means that when you sell the company or you raise capital, the senior capital is the first money out. And so oftentimes when companies have raised some amount of money and then there's a decrease in valuation, the commons are the ones that get squeezed because the stack of liquidation preference ahead of them becomes exponentially larger. And so just think if you raise money at 10 and now you're valued at 8, if you're common stock and you used to have 1, now you're worth not at 0.8 but less than that. And so you're significantly diluted, and your incentive to stay within the company is that much diluted. And so typically after major decreases in value inside companies, one tool that management can and the board can use to incentivize, recruit, retain people is an option repricing, where you go out and you say, hey, I know your option was struck at or was exercisable for $1, and now you may not believe that you have value from that instrument, and so we're going to exchange that. We're going to exchange that option for which is exercisable at $1 for an option that's exercisable for 10 cents. And we might say that as long as you stay for the next 2 years, your options will be exercisable for an additional 5 years or 7 years post-termination. So these are tools that you can use to incentivize your employees to stick around. I am not yet seeing a mass of option repricings or equity recapitalizations yet. But I think that if there is not a swift recovery that later this year, we will likely start to see those kinds of transactions. One final tool I want to talk about is the management carve-out plan or retention plan, which is if the common is feeling like there's really nothing in it for them. Preferred investors can say to management, we're going to adopt a plan that says that if we sell the company or if there's a liquidity event in the company in the next certain period, we're going to reserve somewhere between 5 and 15% of the proceeds to the common holders. And what's market between 5 and 15 is a longer discussion outside the scope of this call. But it's a tool that boards and preferred investors and venture capital investors can use to retain management without doing an option repricing. Finally, as founders look at their own estate plans, it's certainly a great time with the current valuation volatility to be able to say, hey, Lynn, I'd like you to give me an updated report which reflects the changes in environment, and then to go transfer stock from yourself to some sort of a grad or a foundation or to a trust for your kids or something, so that the value that gets transmitted is taxed less. So those are, I think, an answer to your question, Vitaly, to rewind and set the stage as to why is a decrease in value potentially helpful. And I know that Greg has nothing to say because he's never seen a decrease in value. And
we'll give him the next
Greg,
that's actually not true, but
we've talked about decreases in value, but you're the CFO of a really hot artificial intelligence company that is changing the way healthcare gets delivered, and I think is in that sphere of companies that are really benefiting from what's going on. And are you seeing any pressure from your accountants or your investors to maybe increase the valuation? Are you hearing about, and we shouldn't ask you about your own company, strike that. Are you hearing from other, CFOs that some idea that perhaps this event has caused such an increase in value that you might consider a new valuation?
I think unless there is a demonstrated impact on the business itself, so a massive influx of new customers, massive new revenue contracts, I think a lot of CFOs are just sitting on the sidelines with whatever 409A they have in place and just saying, okay, it's volatility up and down. We're not going to react to it. We're just going to keep business as usual and focus on growth. But if I could take a step back to what you guys were talking about before, from a practical standpoint, when you're dealing with teams, while you should always look for ways to help your employees pay more taxes because they have more money in their pocket at the end of the day, and they're always at the end of the food chain when it comes to liquidation preferences and everything else. The key thing to balance with any decrease in a valuation is understanding that by default is a very negative signal to your talents, and really good talent has options to go elsewhere. So your worst case scenario is your best talent leaves and you're left with a mediocre talent who don't have choices to go elsewhere, especially in this kind of environment. So you really got to be careful and this has nothing to do with finance, this is just kind of leadership and communication. You really got to make sure that you're communicating with your team on everything that's being done to drive the value of the business going forward in the future, all the positive steps you're taking to increase the likelihood that this is a opportunistic event as opposed to a definitive event. Because once that negative mindset takes hold especially within an engineering team, it's really hard to get them focused on what they need to do.
That's a great point, and thanks for underlining it. And I think there are a lot of strategies out there to address how to retain employees and key talent, because to your point, you really need to have the right talent. And so when we do management retention programs, we really focus on who those people are that are critical to maintaining the company's operations. But I'd like to switch at this point away from the silver linings in the dark clouds to where is the sunshine? And Vitaly, I know you're out in the market frequently looking for great targets for your buyer clients, and you're looking to work with sell-side companies that have great potential to bring them to market. And what do you think those companies and industries are that are really benefiting from the current environment? And Lynn, you may have a view there as well. Clearly, it's Greg that's benefiting. I would like to start by saying that. But
congratulations, Greg. Yeah, absolutely. Healthcare has become an even hotter topic. It was a hot topic to begin with because it's a $3.5 trillion industry in the U.S. alone, and growing, and constantly very dynamic and constantly changing. So there's obviously opportunity, kind of a net volatility of the fact that things are being changed all the time. And there's always been a big interest there. So healthcare, even more so, is getting a big spotlight on it. I would say something really positive industry that I do a majority of my work in, which is transportation and mobility, is that we're seeing reports out of China now that there's even more incentives to start pushing EV. So as supply chains are being rebuilt, as everybody's kind of coming back to work and factories are reopening and companies are making new investments, they're certainly not investing in the old way of doing business. So kind of the macro picture, I'm glad to see that because, I've been saying this the whole time, is that COVID is really kind of a sneak preview. It's a trailer of what the environmental crisis could do to this planet and to this civilization we have. And we really need to make a move in the right direction. And for economic reasons, now governments are starting to push that, not necessarily for the right reasons, but I'll take it. That's fine. and it's moving the needle for electric mobility and a lot of the positive things. So very, very good to see that. The other thing I wanted to kind of touch on the last point, just one little thing, little nuance that I think will be useful for everybody. From a VC perspective, the VC game as far as valuations and how you structure a deal is you try to structure a deal, your first money out. So if it's a good company, you know, and it even sells at 20% or 50% of its value that you invested in, let's say it's a kind of a disaster scenario, you still get your money back. But you're really optimizing for that 10, 20, 100, 1000x exit. So that's really the venture game, and kind of, you know, we'll probably touch on that again. There's some good questions coming in the Q&A. They're a little bit more technical. But as far as industry is a benefit, you know, it's all these forward-looking things. It's certainly office of the future. It's certainly accelerating things that were already happening, right? So healthcare, new transportation mobility, working remotely, and everything that enables that, and really just being a lot more, you know, optimized. Amazon is consolidating its gains. Obviously, we saw their results last week. I think when we come back, we're going to have a lot less retail, for example. And it's just accelerating, you know, what was already happening largely.
Thanks, Vitaly. Lynn, you obviously see a really wide spectrum of companies, and you may even have some data. And I don't know if you share any data at Cabrillo, but I think just your own brain is probably a database in and of itself. So tell us which industries are benefiting and why and how.
Yeah, and it's somewhat anecdotal, but we see a really wide swath, as you said. I would say there's the ones that I would say you would expect in terms of, you know, for life sciences business, for example, we have a lot of clients that are fairly well funded, and they're pharma or med device, or in the process of testing, they're well capitalized, and, you know, unless they're changing their end market because of this, it's a little bit of the show must go on. You know, unless the investors are facing unexpected difficulty and not able to come up with the capital. But we're seeing a lot of life science in particular somewhat unaffected, and some positively affected as well, as you would expect. Global manufacturing, where people were able to move the chess pieces around, we've seen some success with, for sure. And also in manufacturing and some other industries, you know, there's a lot of companies that have been able to pivot. And, you know, for example, we saw a plastics manufacturer that, you know, would have normally seen probably issues with supply chain and things declining, and was able to pivot and make part of a, you know, COVID test, and all of a sudden, you know, demand increased and the model completely changed. And so it's kind of been a mix. And then I would say also on the technology side, a lot of SaaS businesses still doing really well. Some of the much more early stage ones where they're basically, you know, we're about to raise capital, or we're about to try to really ramp up sales. It's harder to get people's attention right now. But if you already have a successful SaaS business that's subscription based, and that, especially if it's utilized in healthcare or other relevant industries, you know, we've seen a lot of success in that space as well.
One question from the Q&A that I think is topical for you, Lynn, is, are you seeing any trends in non-tech based industries receiving more interest, like localized food production, localized manufacturing, renewable consumer products, things like that? I know you've talked about life science really benefiting, but
yeah,
apart from life science, are you seeing anything in non-tech, you know, ag tech, food manufacturing? I think you've talked about CPGs.
Yeah, I think I would say localized probably being the key there. You know, we have one client that's like vertical farming, you know, and they, I think, have some renewed activity. Almost anything that we can do domestically, you know, we've definitely seen exactly what you would expect, with kind of increased demand to not have these issues relying on others in the future, at least as a current trend.
Awesome, awesome. I've already flipped the slide, but I wanted to address, you know, what companies can do to maximize valuation at this point. And I know that, as Greg noted, oftentimes, you know, when you're doing your updated 409A valuation, you're not really looking to increase the value of the common stock price per share for purposes of granting options, because that decreases its retention value. But you do want to be showing your investors and the world, every time you raise capital, that you've maximized valuation, you've brought it to the next level. For you and your processes, what are the keys to maximizing value? And then to Vitaly, how can you maximize value as you go out to bring your company to market for either a fundraise or an M&A sale? Do you want to start, Vitaly, on that one?
Sure. So a couple of things. First of all, you need to recast your projections for your business, right? A lot of people think that it's going to be kind of the same thing, and it would be very strange for business to continue as usual. At the very least, if you're going to stay in the same category, same business model, you are going to find yourself recasting your assumptions. On the one hand, if you have a heavily advertising-based user acquisition business, if you've been paying attention, online advertising has been running at like a 50% discount or more, depending on the category. So that's nice for you because you can get double your budget out there. So maybe you can show that your growth is actually going to accelerate depending on the type of business. The other part of it is that you need to look at the world, how the world has changed. And just like after 9/11, the world really has changed. After the financial crisis, not as much. But this time around, there is going to be a completely different kind of focus on priorities are going to be reset. So what that means, you need to look at your business and say, okay, we are now living in a different reality. How does that change our business? Do we have new opportunities out there, right? And you want to kind of shoot for a new moon potentially, and think about your business from a different lens. It's a painful exercise to kind of gain that objectivity on your business and be able to recast these things when you've been like probably emotionally tied, especially if it's like a very early stage company, you're kind of emotionally tied and you've invested in yourself many hours and talking to advisors, etc., to think out this business. You're going to need to recast that and then find a pathway to more value, more efficient user acquisition, etc., which would of course increase your value and increase the velocity of your sales.
Yeah, I would just make one point as you bring a company out to market, whether it's to fundraise or to look for an exit. Looking well capitalized and having a balance sheet that has already been cleaned up is super helpful. When an investor or a potential buyer looks at a company's balance sheet, sees no cash coming in and kind of the wall right in front of your company, I think it makes it really hard to engage in a fruitful discussion and have anything other than bottom feeders taking a look at you. And so that means addressing costs, making the hard decisions about personnel and who's really part of the core team. So that would be my answer to that question. Lynn and Greg, what are some other ways that companies can maximize their value when really trying to establish a valuation thesis?
Yeah, I'll jump in. The one thing I'll add to what you just said in terms of the balance sheet is a clean cap table is also very important and very valuable. If you have kind of a messy capitalization table with whether it's a lot of investors or a lot of different types of investment, that can definitely scare off investors as well. And that kind of keys into my theme about maximizing value, which is the best way to maximize value is to minimize uncertainty. Uncertainty is bad for value, essentially. And so to the extent that you can, as Vitaly was saying, reforecast, it's still going to be your best guess, but you certainly want to make sure you don't have a forecast that doesn't reflect the world that we're living in. I can't just, anyone can't just apply a higher discount rate and make up for the fact that it's not really a view to the future anymore. So you really do have to reforecast. And then within that, well thought out. Do you understand which of your costs are fixed and which are variable? That can have a big impact. Have you thought about different scenarios for sort of the key drivers in your forecast? Do you understand the sources of the strengths and the weaknesses in your forecast and in your business? Are they operational? Are they customer driven? If customer driven, is it because you have key customer risk? I think to the extent extent that you can ask yourself what if questions and how those would impact your forecast, and you understand that impact, you take away the uncertainty, because uncertainty from a buyer's perspective is a discount, basically.
Thank you so much, Lynn. And I just wanted to call out just my own reaction to what I feel when I listen to Lynn. There are a lot of valuation firms out there. One in particular that is kind of consolidating what I'll say is the bottom of the market. You know, while some people view the exercise of obtaining a valuation as a commodity product that doesn't have a lot of value in it, I think that when you have a really high quality firm that differentiates itself not based on price but on the quality of the analysis that they do, you really can help yourself in you know, identifying those key metrics that are going to drive value for your company as you move forward. And so Lynn and her partners at Cabrillo, I have always found to be super helpful to CFOs and management teams and boards as they think of what are the key value drivers. So thanks for that, Lynn. And that kind of brings me to the next topic is, you know, what are we seeing in the capital raising markets right now in response to COVID, and you know, what are the key trends? And I guess I'll start so that you all can think of what you're going to say, Lynn and Vitaly and Greg. But what I'm seeing is that the deals that started prior to COVID and were in process have largely continued, and for the most part are getting done, many of them at some sort of a discount to the pre-COVID valuation, particularly in the private equity space. And I'm seeing that venture capital firms took a pause and they looked at their portfolios and have been reassessing them. And, you know, they've been looking at them and thinking, geez, you know, I've got 50 companies in the portfolio and, you know, some of them are going to die. Some of them, you know, that's really probably only one or two that are going to drive the big returns. I need to focus and identify which are those two in my portfolio that are going to be a home run and actually put more money into those companies, because the survivors are going to be the ones that make it to the other side of this. They're going to be the ones that are well capitalized. So they're really looking and picking the winners. I think that largely has completed, that those transactions that were in process pre-COVID are either done, repriced, but some are on pause, but I think for the most part not. And now I think, you know, venture capitalists are at home, sheltering in place, and they're doing a lot of Zoom calls and they're looking at new things. But I'm not seeing yet a flood of new deals, you know, what I'll call Series A deals or seed deals. I think those are getting pounded in the month of April. What I'm seeing are kind of the late stage deals get done where it's okay, let's make sure Airbnb gets to the other side and put some more money in that one, or let's put money in Stripe because it's, you know, such clearly a valuable company. But I'm not seeing a lot of seed and A deals. So that's kind of my perspective, which is, you know, kind of industry agnostic, whatever's in Silicon Valley, tech, life science. Lynn and Vitaly and Greg, what are you all seeing in the capital raising markets?
I can talk about it a little bit. So yeah, I mean, I would echo the fact, you know, the biggest change is the number of deals, not necessarily the valuation. A lot has really kind of seized up, especially if you look at strategic investors. You know, a third of venture capital is strategic capital. And for a lot of companies, you know, they see a huge drop in revenue. So the first thing they're going to do is hit the brakes on, you know, what they consider a luxury is being able to invest off their balance sheet. If they have a separate fund, you know, that's set aside, that's more of a financial function, but something like 80% of corporate venture comes from the balance sheet. So that's definitely problematic. I know a lot of corporate venture units that basically hit the brakes 100% and said, we're going to pause through end of May, beginning of June, through the second quarter, what have you. And I expect that as we get through the year, a lot of corporate venture units are going to close altogether, just like we saw every other downturn for same reasons. Yeah, certainly you're going to see that you know, VCs are not going to be willing to start building new sandcastles when there's a tsunami that's taking away the ones that they've put in so much time, resources, and money into. So there's definitely that type of behavior. I think we're going to thaw out pretty quickly if we're looking at kind of other regions. The return to normal-ish, is rather quicker than I think most people were fearing as a worst case scenario. So that's probably a silver lining there.
Yeah, and I would add, I think one trend that we haven't touched on is in some cases may not even be a change in value, but we may see more stringent terms on preferred that's being issued, and more likely that it's coming from existing investors, to bridge, because either I can't raise in the market right now, or I just need a bridge to the next fundraise. But one thing to just remember there is the more teeth your preferred has, kind of for better or for worse, that has a downward impact on the common value, which we talked about, for the strike price of your options can be a good thing in one sense. Although I like Greg's point that, you also have the psychology of it where you don't necessarily want that to be too low. But just worth remembering that kind of the more teeth and value the preferred has, the less that then kind of falls to the common.
Yeah, and I want to accentuate a point that Vitaly made, is that I think that we saw in the Q1 data that mega rounds really increased, and that the value of capital being deployed in venture didn't fall off a cliff, but the number of deals absolutely did. And so we're seeing these large mega rounds, big slices of capital going into successful companies with teeth, Greg, do you find that employees generally, and I'm not talking about any specific company and not yours, but do you feel like rank and file engineers really understand the preference stack and the potential consequences? Do they ask questions?
Absolutely not.
Yeah.
I have found in the past I have to explain a lot to them so they understand. But that's also part of an education process for people. And your job as a leader of a company is to look after your people, and help them understand what is the value of their options. If I could add a comment on the raising capital topic, though, it really comes down to why you're raising capital, right? If you're trying to raise capital because you need it to survive, that's very different than trying to raise capital as a bridge or because you have a massive growth opportunity now in front of you. And that's also going to impact the type of capital you're going to raise. If you're in survival mode, you're probably going to be limited to debt at very lendor favorable terms. You saw big companies even having to pay 10%. Even in the financial crisis, you saw blue chips, having to pay, preferreds that were paying out 9-10%. I've seen companies, that, basically are looking to lend at 15%, which is a very steep cost of capital from a cash perspective. Probably still cheap in terms of growth equity, but you're going to have a very difficult time trying to sell growth equity capital to an investor unless you're really clear on the advantages that you have now that you can defend and will continue to be able to defend going forward.
So Greg, and there's a question in the Q&A that I think is particularly valuable. I'd love to get your perspective. If you were fundraising, which you're not, and we're not talking about anybody's specific company or any specific, real life situation here, but just by way of hypothetical, if you are looking at term sheets, what are those provisions that you're really wary of? What makes a dirty term sheet in this environment right now?
Any term sheet that includes basically heads I win, tails you lose would be an automatic red flag for me. And obviously, as Vitaly mentioned, the way the VCs work is, they try and protect their downside risk and maximize the upside gains that they can have. But you also have to balance it with, if it's too stringent and you have too many preferred overhangs, then you'll end up in a situation that we had not too long ago, where we had a lot of people trying to raise money at unicorn valuations, and very few people were actually paying attention to the details of those terms. And if you looked at the terms, what you found was the employees, were basically left holding worthless stock at the end of the day, while everyone else was protected. So anything that starts off with almost like a signal that they're not looking to find the right balance, but they're trying to play a heavy-handed negotiating game, that would be a massive red flag for me, because it's not just the capital you want, but it's the people and the relationships that come with that capital and the resources that come with that capital that you're also looking for, not just the money itself. And unless you're in survival mode, then you don't have a choice. So
Vitaly, you and I have seen some dirty term sheets together on deals. You want to call out some of your favorite dirty terms?
Oh, sure. I mean, the liquidation preference, when you have multiple liquidation preferences where the investor, just to kind of explain what that means, the investor gets a multiple of their money back before the next person in line, next group in line gets the first dollar. That was something around in the .com days, was quite common, and it kind of went away, where they at least get their 1x money back before the money gets spread out to the rest. And what Greg was saying, yeah, a lot of these unicorns with these huge headline valuations, if you look under the covers a little bit, you'll see that those stock options are worthless. And I have, friends that went to big companies and asked me for advice. Hey, I'm getting this many shares. Is that good? I'm like, well, okay, how many shares are outstanding? You need to start digging a lot more. My favorite term that I've seen a couple of times out in Europe is a ratchet. So raise your hand if you like ratchets. Ratchet, what that means is that at some point you're going to, at some specific point in time, 6 months, 12 months, you're going to reevaluate the company based on how close it came to your sales projections. And then you're going to reevaluate and likely adjust the valuation down and issue more shares to that investor just for hanging out. So that's some real kind of downside protection. At that point, it's not really an investment as much so as it is kind of, some kind of a equity debt evil combination.
And Vitaly, if I could jump in, just I have a really good example of that. When I was in China, there was a US company that invested in a Chinese company, and they put ratchets in place. And the ratchets ended up triggering to the point where the US investor owned 95% of the Chinese company. And that was basically the death knell. The Chinese, the Chinese partners basically picked up the business and the assets, moved it somewhere else, and left the US investors holding an empty shell. And that's where it comes back to you have to find the right balance, because you can end up holding 100% of nothing at the end of a heavy ratchet.
Yeah, at the end of the day, it's a relationship. So everybody has to be happy. It's not a transaction. That's the important thing. M&A is barely a transaction because, usually the team will have to stick around for some period of time. For you, even as a buyer, if you want to kind of get away with, stealing the bank, okay, fine, you got a great deal on the company, but you're going, most of the value in tech companies are the people, the customers, the people that have the relationships with the customers and all those things. And if those people are not happy, that transition is going to be very lumpy. Most M&As don't work out long-term because of that. So you really have to, from all sides, you really have to have a relationship and a win-win, not a, like Greg said, tails I win, heads you lose kind of situation. Absolutely.
I'm going to do a little time check, and we're at the 1 hour mark. So I want to accelerate here and make sure that we answer folks' questions. I would just add, before we move on raising capital, the other dirty terms that I see in term sheets are conditions to tranching financing that are kind of illusory. To your point, meeting some sales or metric of profitability or growth, after which you revalue the business is certainly one. And then in the convertible term sheet, having a multiple of your money back. So for example, the typical one is if you sell the company, you get your money back ×2 or ×3, which is more than you would have gotten by ×2 or ×3 had you invested in equity. And so I find a lot of those bridge term sheets have really onerous terms, and there's something to watch out for. flipping into M&A, what are you all seeing in the M&A markets in terms of, our deals closing? And I would say, just answering for myself, I'm seeing the same as I did in VC, where, deals are still getting done, but many of them are getting recast with a pre-COVID discount, some with a COVID accelerator, where they're clearly benefiting from COVID. But I'm not seeing a lot of new deals, that just snapped up out of nowhere. Maybe with the exception of Verizon buying Blue Jean Networks to compete with Zoom. Not a lot of new M&A. Vitaly, what would you have any comments there?
Yeah, absolutely. So statistically, I've been keeping an eye on it. Statistically, number of M&A transactions has certainly fallen something like 25, 30%, if not more. I think we're going to see some fire sales that happen. I mean, for companies that, needed to sell within the first month or 2 months of the disaster, they're probably, for most of them, they're probably going to go to zero. I hate to say it, but for smart buyers, they're waiting for these companies to kind of exhaust a little bit so they can pick up the assets, let's say in the next month or two, kind of a quarter down at a discount, and be opportunistic. Of course, there are certain things that are kind of right on the head, like Blue Jeans, etc., being bought. That was a very direct effect, and those things will always happen. But yeah, generally, again, kind of less transactions. There's some pressure from legislators to kind of cap big time M&A to make sure that the monopolies, the big four monopolies, don't get even stronger in this scenario and kind of take advantage of the situation too much, because they have hundreds of billions on the balance sheet right now.
I think we're running out of time, so I'm going to go to the next slide. Any impact of the CARES Act on valuations? I'm not sure that I think that there is one. I'm seeing a lot of companies give back the money that they got, in fact, because they're scared now that there's going to be a witch hunt in 6 to 9 months for companies that didn't really qualify for the money. Any real changes there, Lynn?
I'll give a quick answer. I mean, I think it comes back to projections again, just making sure that you have identified any assistance that you're going to get, and that you've evaluated, is that forgivable? Is that actual debt? Has it happened? Has it not happened? Is it in your cash flows? I mean, at the end of the day, make sure you demonstrate that you understand your cash flows, and this can obviously have an impact, and so it should be reflected. The one thing is also there's a little bit of extra NOL usage that's being allowed, and so from a valuation perspective, if you have a lot of losses, that could have an impact.
Yeah, I think for venture scale companies, it's such a rounding error that it's probably not even on the radar as far as valuations go, or long term.
Well, thanks everybody. I know we're going to start to lose people, so I thought I would just hit the Q&A quickly. And Philip Miller asks, what's the first money out deal called? That's a liquidation preference. Can you set up a 3x buyback scenario? I think you can set up any kind of scenario if you're an investor. Let's see. We've got one question is, if you're a pre-revenue startup looking to raise seed in order to survive, what's the answer, debt or equity? And I think the answer is any cash that you can raise.
Yeah, the answer is yes.
I think, what are the medium-term prospects for funds flowing into the venture category? I think that established funds have continued to do well in terms of fundraising.
Mm-hmm.
So the Sequoia just announced a big new fund. NEA just did a final closing on Fund 17. A hugely successful raise. So I'm continuing to see the consolidation of LPs into high quality funds that are really, really large. And that those companies, because of how large they are really focused on what I'll call growth stage equity deals rather than the seed category. There are a lot of seed funds, but I think they're having a real, that category of the fund market is going to be really challenged in the next year. And so I fear that there's going to be a real squeeze on seed companies. And so it's going to be up to the angels and the friends and family to carry the the pre-revenue companies until they can get to some metric of success. And in the enterprise SaaS company, that's annual recurring revenue, monthly recurring revenue of X. You got to get to that point before you can really get the attention of a decent sized fund. I don't know if Vitaly or Lynn or
Yeah, I
Greg.
can add to that. I've seen seed VCs really hit pause on new investments and really focus on supporting their companies. If we're talking about kind of the high velocity seed VCs that have hundreds or more in their portfolio, I won't name names. They're looking at the entire portfolio and seeing who's going to benefit from this. First of all, that's a small minority, and then they're seeing something like 25-30% of the companies that will not survive this at that stage, even professionally seed funded companies. And they are supporting the rest to make sure to kind of really look at them very, with a big magnifying glass to really understand their business and see if it's worth supporting in the new reality, or hit pause, or a combination of reducing burn aggressively and all those things. So that's that. And then there's generally a flight to quality in times like this, when people are scared, when there's uncertainty. It's not surprising. There's still allocations towards venture capital from LPs. It's just going to be much more going towards funds that they know, they can see the performance of, and not so much speculative bets on new fund managers, unknown funds, or kind of more speculative thesis that newer, smaller funds are doing to stand out.
Thank you, Vitaly. I'm going to give you, Greg, a softball here because I think this is something you're really, really good at. And as I've seen, there's a question from Rick Andrade about what business owners can do to preserve and increase value.
Yeah, I mean, I'll go back to my earlier comment. It's all about advantages and how you can defend those advantages and basically sell a non-fictional story to potential investors and acquirers about how they can leverage those advantages to scale their businesses as well. I think what you saw in the past was a lot of kind of fiction, Theranos, WeWork. There weren't real products, weren't real technologies, weren't real business models. At the end of the day, if you want to maximize your valuation and your value, you have to maximize your advantages. Everything stems from that. Your cash flow, your ability to attract talent, all starts with that.
I think we should end there. And Greg, Vitaly, Lynn, thank you so much for joining. I think you shared a lot of really valuable insights. For anyone who didn't ask a question or did and didn't feel like it was answered, please feel free to reach out to any of us on the call. We've set out email addresses, and you can find me at l2council.com, and I'm happy to connect you as well. So thanks again to everyone for joining, and really appreciate Lynn, Vitaly, and Greg. Have a great week, everyone.
Thanks, everyone.
Thanks, everybody. Thanks, Louis.
Bye-bye. Thanks, Louis.
Thanks, Vitaly.
And we're out.